Hello, I'm Stephen Galpin and welcome to A Focus on Property Development Accounting. Joining me today to take us through the intricacies of tax, structure and exit is Zee Razaq, Managing Director of Certax Accounting based in St Albans. Zee is an expert in the field of tax accounting for property developers and has a wealth of experience in the property industry. Zee, welcome to our studios here at Property TV.
Thanks, Harry, Stephen. I'm really excited about all the stuff we're going to get through today.
Good. Well, I'm just hoping I understand it all. That's all. Zee, you've been on a number of our programmes before, and we've often talked about the need to make the right decisions at the beginning of a development and have your team around you who will give you that advice, which will take you through. So I think where I'd like to start from is the acquisition of property, the various ways that you can effectively make these acquisitions, and of course the structure that you put them in, because these are critical, are they not?
You've hit the nail on the head, and I know we're getting into a lot of detail on this. I think the biggest challenge is people to understand why this is important. The reason being is if you don't do this, all that hard money that you're earning from doing the development, all that pain soon disappears, and you're like, well, what have I got left with? And it can be mitigated. And I think you mentioned the acquisition part. And if we start with that, when you acquire, depending on what you're acquiring, so important, because there's a tax that you get hit when you acquire. It's called stamp duty land tax in the UK. And it depends on what you're acquiring and how you're buying it. This can vary. And the highest marginal rate, believe it or not, it can get up to say 17%. It's 15%. And then if you're abroad, they whack another 2% on at the moment as well. So you've got to really understand what you're acquiring and what you're going to do with it.
So 15% is the basic stamp duty level for a development project?
But, yeah, depending on the value of the land and property.
Okay.
And that can then be the highest level that you can
What's
get.
the threshold for that kicking in?
I don't know off the top of my head actually the numbers, because there's different ranges, and it depends on, there's two different types of stamp duty as well. There's the normal standard and then there's the surcharge. And now you've got a third bit, which is the foreign aspect.
Yeah.
So that's why it's thing, but the highest rate is 15%.
Okay, all right. So when you're looking at acquiring these things, I mean, for instance, if we take two examples, you might be acquiring some land.
Yeah.
That stamp duty level would apply to that land purchase?
Depends on the value of the land.
Okay.
So generally, in the UK, how it works is when you buy land or residential or commercial property, dwellings as they call it, the technical word, is that stamp duty starts kicking in from about 40,000 upwards.
Okay. Because
you have the surcharge. And then if it's residential or commercial, it's 125 or 150,000.
Okay.
And that's the normal standard stamp duty. The key bits is how do you mitigate it? And you mitigate it by depending on what you're going to do with it and what agreement can you get with the person who you're buying it from. So let's say that you've got a commercial property and you're going to potentially convert it. You can get an exemption to reduce and get rid of the VAT, i.e. you don't have to pay it, and therefore you don't have to pay stamp duty on that additional pound for the VAT. Big saving. If there's a tenant within the building, you can get something called a transfer going concern and therefore not have to pay the VAT. You can't be the tenant. Right. There's some restrictions on that. The other bit is if you're actually a developer and you're buying it and you're going to do multiple dwellings or the work has already started, and this is quite beneficial for the audience because you won't find all of this information. You have to know it through case law and decisions that have been made. What you can then claim is a lower rate and spread it. It's called multiple dwellings relief. And this can be very powerful depending on the makeup of what you're buying.
But I suppose it can also help if you're taking into account the time it's going to take you to develop.
Yes, and I think you've got to be really careful what time is considered completion or an exchange of contracts, because that's the stamp duty date.
Yeah.
And people get a bit confused around this, but HMRC have had it very clear at the time when you've got control, basically.
Right.
And getting this structure on the acquisition, the stamp duty, the VAT, is so important because they're the biggest ones that you'll probably get hit. If it's commercial property, for example, there's likely they would have VAT. Even if it's land, it may have been opted to tax. Then it depends on what structure you put it into. And this is the point where, yes, I've saved money on stamp duty VAT because I'm a developer. Just for the audience, developer means I'm going to sell what I develop. I'm not going to hold on to it. Very important, because if my intentions change, it changes our conversation. So
can you go back retrospectively and change your intentions?
This is the area where there's been a lot of challenges, as you can imagine. It depends what you documented, because if you change your intentions, you change from a developer to investor.
Right.
And if I started as a developer, and this is where I'm going to get a bit technical with accounting, it goes on the balance sheet as stock, right? If I change from stock to an investment property, I become an investor, that triggers something called capital or corporation tax in a company, or capital gains tax in your own name, charge. And that's quite painful.
So would I be right to think then, as long as you make any change of minds within the first 12 months before your accounting period is up?
Before you do your confirmation step, potentially, or depends on what your SIC codes are. That's one thing. And number two is what you've documented on your board minutes.
Yeah.
Definitely by the time you do your accounts 21 months in, that's normally the deadline submission. If it states whatever it is that. And you can be careful, because if you start as an investor and move to stock, you can defer the tax, i.e. corporation tax if it's in a company, and in your own name, potentially capital gains or income tax. So getting that right is so important. And people will say, why would I be a developer rather than investor after knowing that? The reason being is developers are trading businesses. And trading businesses, when we get onto exit, have special reliefs, which investment businesses don't.
So I suppose it's also important to make sure that you're not acting ultra vires of your articles of association, I suppose.
Yeah, it depends on how you did it, whether you went on the standard ones or you were really complex, and when you set those up. Most developers, from my experience, depending on what level GDV, gross development value projects they do, they don't get into that deep into those. But it's good knowledge. It depends on how you structure the business, whether you're getting, and we'll get onto leverage, how you financed it. That changes how you set it up from a shareholding perspective.
Well, that takes us nicely on to the next stage, which is what structure do I create to hold this asset that I've just bought? And I suppose when I mentioned articles of association, I know you're keen on sort of group structures, aren't you, for this sort of property holding group or collection of companies, and you've got to, I suppose, make sure that it's within the articles that you can create these situations.
It is and it isn't, because you have standard articles these days. Company House have become a lot more relaxed on those. It's only when you have unique structures where the articles and a legal person becomes into
But I would have thought changing from an investor to a developer or vice versa would be quite critical, would it not?
It depends on the standard terms. You would change the SIC code.
Okay.
They've made, that's what's
easier then.
They've made it a lot easier, because they used to be more complex, especially in the early noughts. They've made it less of issue. The biggest challenge I think people find is when they change the shareholding and what those shares represent. That definitely needs both legal and tax advice to do that, and potentially financing implications as well. So if you don't get them started at the beginning. And I think you mentioned something really important about group holding and why I talk about groups. When you're a developer, it's very likely that you're going to do serial developments. You're not just going to do one and call it a day. If you don't have a group structure, and I think we mentioned this on some previous programs, what ends up happening is when you close that structure, because the banks and everything like clean structures, what they call it SPV, special purpose vehicles, fancy name for a limited company that holds property, right? They want them in a good structure, right? So they can close that and they know what that performance was and then go again. But if you close it, that money then has to be subject to personal tax, which you don't get when you do group business, because you can just move the money to the parent company, pay it via dividend, and that's outside the scope of tax.
So the parent company can have a dividend the same way as you and I could have a dividend as directors or shareholders.
Yeah, the big difference is when you take a dividend individually, you're subject to personal tax. When you do intercompany dividends, there's no tax.
There's no liability at all.
Yeah, it's just an accounting, not a tax adjustment. Massive. The other big, and we're going to get into some exits, and I love this part, right, is how do you structure that shareholding? And you've got to think from a number of different perspectives. One, JV finance, and I don't know if we want to chat about that later, but if you structure it, you've got to have the shareholding correct of what the parent owns and what individually some investors own. And the reason why is because, or even you as an individual, is you can take three major reliefs there is. The ones that we're going to talk about here. Something called substantial share exemption. That's when you put money from your subsidiary to your parent on a winding up the company, provided it meets the criteria. The other one is something called entrepreneur's relief, which is now called business asset disposal relief.
Right.
And that's when you want to take money out on a wind.
And that's a special situation for you, shutting down a company and taking your capital and money out of it, yeah?
Yes, out of the subsidiary, provided you meet the criteria. And another one is something called investors relief. And why I want to talk about this is, it sounds similar to entrepreneurs relief, but they are different. That's for someone to invest money in. And that still, believe it or not, has got a 10 million lifetime allowance. Okay. So that means potentially you could save £1 million of tax, because when you wind up shares, it's 10 or 20%.
Right.
And that's substantial.
Well, all this is quite critical to the structure, isn't it? I mean, it would be so hard to unwind if you didn't get this right at the beginning.
Yeah, and there's a lot of anti-avoidance measures as well, and also what you're going to do in the future. Because some of the key taxes we're talking about, stamp duty, land tax, corporation tax, and capital gains, they've got special rules around if people have not done it in the right spirit of the law, as they say. So you've got to understand what you're doing, why you're doing it, and what your future use of all that money is.
Just finally, for this half of the programme, these are quite complicated setups, and I suppose are open to some either question or criticism from revenue, or shall we say testing by revenue. How much negotiation would you expect to have with revenue over the structure of these companies? Is it all very, very clear and just a matter of ticking the boxes and following the structure, or do you have to enter into negotiations with your local revenue, presumably?
They've got central or localized, central offices for different areas. And what changes, it depends on whether you change. If you've done it set at the beginning, there's less confrontational issues with HMRC. It's more if you change structures. So I started a SPV and I was like, oh, I'm a developer, I should have really had a group company. Then I have to insert the group company. I have to ask permission from HMRC. Okay. Right? It's called a share for share exchange, and you have to get HMRC clearance. And you have to justify to them why you're doing that. Okay. And if you say, oh, it's because of tax, they'll just laugh you out of the room.
I'm sure. Okay, well, on that note, we're going to take a break. Join me again after the break when Zee will be explaining even more of the complicated structures you're going to have to put in place if you want to be a successful property developer. Hello and welcome back to part 2 of Focus on Property Tax Accounting with Zee Razaq from Certax Accounting. We're getting into the depths of the complexities of your tax situation and your structure of where you're going to hold your development project. Now, Zee, we talked about this group structure that you're advocating. I can see the tax benefits there of moving money up and down as you come to the end of one development and want to move on to the next. I'm interested to know what you think the bank's view of this kind of structure is, and does it make your application for funding more complex, more difficult?
A great question. It does. A simple reason, because not every lender or institution, being a person from the banking background, they don't all understand it. But anyone who's involved in property, you won't have access to the whole of the market, but you still have access to a substantial part of the market, because this is a well-known structure, how to structure a professional property development business, because those guys or ladies will have multiple projects running, and this is the only way to do it. I think the more complexity banks find is who owns the entities. That is the area where they start getting a bit more into.
I was going to say fidgety is probably the word you're looking for.
Yeah, I've had so many conversations with banking bankers, and it always helps because I've built that background as well. When you're having the conversation, I used to work for one of the major banks, but the challenge you find is lack of knowledge. So when there's anything that's not vanilla, bog standard, they then start turning around and thinking, is that allowed? Is it, or what's the issues? Why is this person doing? So they need that good point of call.
Well, there's two things here, isn't there? There's one, obviously, the financial level of what you're trying to do. That will, to some extent, dictate at what level you're dealing with the bank at. I know here in Canary Wharf, we've got a lot of head offices of the banks, and I know more than once I've been hauled up to the top floor and say, right, well, you can explain to the credit committee what exactly you want to do. But actually, that's very fortunate to be able to get in front of those people and make the explanations. I can imagine if you're in the suburbs and you're perhaps dealing with a local manager or a regional office, it's going to be more complex, isn't it, to get what you want through?
I think you've raised the key point. What they look is risk. And I think the experience of the property developer and what level and what they've achieved in previously makes a big difference. If you've got a seasoned pro property developer, or they've got the right property accountant, tax advisor, and I emphasize that because they're normally the people who then liaise with the institutions to explain to them what's happened. And in our industry, we are still considered independent, even though we are working for the client, because we are chartered, you're part of registered accountant, tax advisor. They know that your word means something. It's even the modern day, and that's the liaison point. So you need someone who actually understands the financing, understands the accountancy tax side, can have that conversation, and also understands what that leverage means. What's the risk for the institution or the person lending the money, and the person who's receiving the money.
So once again, we're underlining the importance of having your tax advisor right there at the beginning, and that's going to take me to the next stage, which is I'm going to say, how involved would a developer expect his accountant, his tax advisor to be during the life of the development, and what sort of benefits can that bring if he is involved?
I think when during the project, it becomes less probably about the tax as you've structured it, and then it's more about the exit. It becomes the advice, like the business advisory, actually understanding where the business is going and whether it's been successful, and then having that conversation with the financial institution who's lent the money, because a lot of people leverage and they get business leverage. That becomes critical because if you're a bank, you're going to want key milestones and reporting against those key milestones.
Yes.
Have they achieved this in month 1, month 2, month 3, whatever the normally typical projects, 12 to 24 months for developments. Have they achieved it? When are they going to be accessed the next portion of finance? Because they don't give it all day one. Here, have 5 million straight away. They say, here's a little bit. You've got to have your seed money initially, and we'll give you once you reach this milestone.
Yeah, absolutely.
And that's where you come to your own, and it's how you set that up. And that's a very accountancy business advisory question.
Well, I've been sent in many times by banks to go into a development who the bank are thinking are in trouble or having a problem. And it's nearly always the same. The bank will say, well, we feel like this because we're not getting any information. We're not being in receipt of reports, progress reports, what's happening on the ground, what the level of sales interest is in the project at this time, how the builders are performing, how the contractors are performing. And it's just lack of information which creates nervousness, doesn't it?
You've hit the nail on the head, and also that forward-looking view. So people don't just want what's the current performance state. If I've got a budget and this is what the financing is covering, am I going to achieve that? Is it going to come under, if you're lucky? Or is it going to be over, and what are you doing to mitigate that? And they want that rolling forecast perspective. The other bit that I think people forget is our friends called VAT, right? If you manage your project efficiently, you can benefit from the VAT being an injection of cash flow, because most projects should be based on invoice. What that means is when I invoice, that's when it comes liable for VAT. Initially, you'll be incurring costs, won't you? So if you do, for example...
You're only incurring costs. Yeah.
Exactly, because your sale is going to be once part of it's completed, and then your marketing plan comes in, how you're going to market to the market literally to sell the developments. You'll get the cash flow as you come along. Managing that and being really smart how you sit with your suppliers, as well as how you deal with HMRC on the recovery of VAT, can be huge on your cash flow. It can save you financing on bridge finance and timing, and also give you that liquidity that you need, because projects fail because of liquidity and bad decisions because not knowing what's happening in the project.
Okay. All right. So moving along then, we're taking this a nice progressive steps. So we've had our accountant's advice throughout the project. We're coming now towards the end. And I say towards the end because it's no good waiting until the end, until you start making plans about your exit, is it?
Absolutely, and I'm going to introduce, and I know we speak about, I'm very passionate about it, something called SaaS pensions. The reason why I'm stating this, that when you've got, you know you're going to make profit now, you've got to a point, you've done the project, it's on time, on budget, quality, cost, normal project management. Now you've got to the end of it and you know I'm going to make some money and I'm comparing what I'm going to make. I've got potentially a huge corporation tax bill, because when I sell it, the uplift is going to be subject to corporation tax,
sure.
right?
Yeah.
So now I have to decide is how much tax do I want to pay? And that's what's so important. But if I haven't got those numbers and don't know when my year end is and I had the right forecast, I can't make these decisions. The decision then becomes is how can I minimize my tax position? And something like a SaaS pension is such a fantastic tool, because you can actually make a contribution from the business, i.e. on sale, before its year end, and that'll be tax deductible into the pension. And then you can then potentially use that money in the future to loan back to future companies. So these are certain advantages of knowing what's going to happen and then having good exit strategies. The other one is how much money am I going to reinvest in the business going forward, outside pension contributions. That comes back to the share structure, which we were talking a bit off air on, is if I've got something called a substantial share exemption, that's the parent company owning the subsidiary, I can also have shareholding in that subsidiary of my own as an individual. And provided I meet the criteria, I might want to extract some money out. So provided I know the profit and I meet the right criteria, I can do something called entrepreneurship, aka business asset disposal relief. I know it's a tongue twister, so I just call it entrepreneurship. And I can extract money out to live on tax efficiently, and that could potentially save me £100,000 because it's the difference between 10 and 20%. 1 million, 200 grand if I don't do it, or 100 grand if I do it, and that's the saving.
That's very good. And that, again, it just underlines the need to plan, doesn't it? I know I keep coming back to this, but this is really the key to everything, isn't it?
Yeah, and I think one of the other bit is, and we haven't really got into detail on, but if we can go for a few minutes on that, is a leverage. How are we actually financing this? This is where you've got to have someone who understands finance. And for me,
sorry, I was just going to say that this is where the planning comes. Is you've got to divorce yourself from the sort of the personality of it. You've got to say, look, there are my requirements for some cash. There's the ongoing requirement of the company for some cash for reinvestment, for onward business, because very few people go into a business and say, right, I'm going to build that little building over there and then just kiss goodbye to everybody and everything. You're an organic organisation, aren't you?
Absolutely, and where you're going to have third parties. So for me,
your investors,
exactly, and it's them breaking it up. So firstly, what you're going to invest into the project, if you are investing, that's personal leverage. How are you going to use that money? Does it meet your terms of criteria wherever you're getting that from? Secondly, how are you going to leverage from the financial institutions, other leverage loans, from the business leverage? Third one is investors. Who are going to be investing in? How have you enticed them into the business? Have you get on good terms? Do they know what benefit they're going to get? And there's something called investors relief, huge benefit, I think I mentioned. And fourthly and lastly is if you've got a pension rolling, that can actually invest money in. So you become your own bank. So that's 4 ways of financing a project. And that's the biggest issue people normally have to do this. Where am I getting the money from, Zee? That's what they say. I'm like, well, have we gone through all of this? And then when do you see, and that also affects your exit, because you've got to keep all those different personalities happy.
And again, for future investment, your bank's going to be ultra happy to see these structures in place and understand exactly where the profits are going, where they're going to get their interest payments from, where they're going to get their exit from. I mean, exit for a bank is critical, isn't it?
Absolutely, and I'll put it down to like credit cards. If you borrow from your credit card, for example, if you keep on and you're regularly making their payments and you use the credit efficiently and your credit score's right, they're likely to lend more money, aren't they? Why is that different for businesses? If you do that effectively, you keep your stakeholder, which is your bank, your financial institution, happy, then they're going to leverage and give you more going forward because you've got a track record. So it's all about relationships, managing those stakeholders, and that's what you grow a sustainable, scalable business.
Well, there we are. Now, that's all we've got time for today. So a big thank you to Zee Razaq for filling us in on all the implications of property development, its taxation, its creation and its exit. All very valuable advice for us all. So big thank you to you, Zee. Really, thank you so much.
Thank you for having me.
Zee's Managing Director of Certax Accounting. So he's very knowledgeable, very well versed in these matters, and my advice is listen carefully. So look forward to seeing you next time on our next Focus programme.